Hi, it's Drake Griggs with Obsidian Wiz, and welcome to another Retirement Readiness Thursday. Today we're with Richard and Janice. This is one of those where they were dealing with the recession in 2020. You had COVID going on, the market was losing a bunch of money, and they did what a lot of people did. They left the market. And they're trying to figure out, can I get back in? Because now they're retired and they're not sure if they have enough time to fix it. We'll go through the numbers so that you can see what is actually happening and whether or not it's something that you're actually able to maintain, have nothing to worry about, or whether being too conservative too early is something that we have to adjust in our retirement. So in this particular case study, what I would do is I will share the plan with you, and then we'll go through why we did have to make a certain adjustment to their plan. And if you've been around, you know that I talked a lot about the idea of making sure that we're at least keeping up with inflation and how important that can be to the success of our overall retirement plan. And so when you're looking at having most of your money that's sitting in cash, they actually were going to end up running out of money. Now, we're very conservative in the plans that we build. And so this one was going to assume that everybody lives to 90 and things of that nature. But you can see that it was not going to be able to keep up with inflation. So without getting too crazy in it, the idea is we know that the cost of things goes up. And if we can't have our money generating more money, then we're not going to be able to maintain our lifestyle. Think of it no different than when you were working. If you did not get a 2 to 3% raise at a minimum every year, didn't you feel like you were taking a pay cut? I know that I would, and that's because you know that you are. You know that the cost of things are going up over time. And if you are paid the exact same amount, then you are actually taking a pay cut. And so the rule of 72, very fancy way of saying that about every 20 years, the cost of something doubles. If you assume inflation is about 3% every year, which is kind of what we assume on average. There are some words a little bit higher. There's very few words a little bit lower, but 3% is generally what we estimate inflation to be. And if you look at things like the cost of a car right now, it would not be crazy to have a car payment that is six, seven, $800 a month. But you and I both know that 15 years ago, you probably would have thought that was absolutely crazy, that you must have some sort of a sports car, some sort of fancy luxury car. But today, we know that that's just kind of the cost of some cars. We know that you could have had a car payment of 250 and you could have had a mortgage of 100. You then know that at some point the cost of a car went up to maybe like 400. And then the cost of your mortgage went up to maybe like 1500. And now it's not crazy to have a car payment at like 800 and a mortgage at 2000. That we know that the cost of things go up. And as the cost of everything goes up, we have to have something that is able to keep up with that, where its value is going up in a way that maintains my lifestyle. And so when you're looking at the plan, let me go ahead and share with you why that didn't work. So we're going to go to the cash flows. I don't show these all the time because it's a bunch of boring numbers, but today we'll be able to show kind of what's going on. And so you can see that at the beginning, this is where all the money is at. We had about 56,000 that's in a taxable account. We have about 600K in like our 401K and 403B type of an account. Our traditional IRA has about 125K, or Roth IRA has 40,000, gives you a total of $841,000. That's what we had in the investment account when we decided to retire. Now, if we are not keeping up with inflation, right, they had, I believe I can actually show it to you. They had, right, so they had like 66% of their money that was sitting in cash. They had about 30% that was in bonds. And so that gave them a return that was going to be roughly averaging about 3, but as you know, the bond market kind of varies. And so for their particular one, it was something that we're like, hey, we got to make sure that we're keeping up at least with inflation. So you have that background information. And then you go back to the cash flows. Click, click, click. And we're not worried about the waterfall. We're actually going to look at the boring numbers today. So you can see we start at 41,000, then you assume, right? So we're 60 and 62. Then we assume that we start taking the money out of the accounts to fund our retirement, and then it's offset with the money that we would be generating from our investments. And so you can see that we are spending more. And so it's going, but we're still making some. So you can see that basically the account is going down about $20,000 every single year because the return that they're getting on their investments, right? We said on average it was about 3%. and then the amount of money that they were spending that they were not going to be able to maintain it. Sometimes the way that I describe it to you guys is sometimes it's nice to have just a little bit of a cushion, right? Just a little bit of a buffer. We're not trying to hit home runs, but just the idea that if I'm spending less than my money is making, I just feel better, right? You just feel like, hey, well, my investments generated me $50,000 this year, but I only spent 40,000, so I have an extra 10,000 next year. And if I'm able to do that for a few years, you are actually seeing that you're going to end up with a larger cushion. And cushions are nice in retirement because we know that the risk of retirement ends up being a handful of things, right? Inflation is one of them, healthcare is one of them, and then market downturns is one of them. And so while we're not in the market, right, 65% in cash, so we don't have to worry about the market downturn, we do have to worry about inflation and healthcare. And so this particular plan, we actually just had the average healthcare expenses, and I'll show that to you. But you can see that, all right, they are generating some of the money, but they're not generating enough to cover their expenses. So they're slowly seeing their account decrease each and every single year. Now, you and I, depending on how much we have when we start, that's whether or not that's a concern, right? They didn't have a pension that was already set aside. And then the amount that they had based on two people in the amount of money they'd want to take out with conservative investments, right? Like that's the caveat. Everything is relative. If you were to go buy a business with $600,000, I would imagine you're probably going to generate several $100,000 a year because that's how businesses work. You can only sell them for a certain multiple of what you generate every year. So if my business sells at a multiple of five, so that means that even if it was $500,000, that means my business is generating $100,000. So right, it's relative. If you bought a house, well, we're only putting 20% down. I'm generating a monthly rental income. You have to play around with the numbers with the mortgage and things like that, but maybe that would be more advantageous as well. But if your money is sitting in investments, normally we use the rule of 1,000, which is a very fancy way of saying that for every about $250,000 that I have in my investment account, I can generate about $1,000 a monthly retirement income. Right. So everything is relative to where we have the investment at and how you feel about it. So when you're looking at the proposed plan, so we just increase the return. And even if it's a small amount, if you're able to do it over a longer period of time, you can see how it works for you. And so while we're not slamming it out of the park here, right? We're not going crazy, but you can see that now we've at least adjusted the investments in a way where we are at least keeping up with what they're spending and inflation. And there is a small little bit of a cushion. You can see that in the first one with 65% in cash, now we have about 7,000 that we have left over. Right. So again, not a home run. We're not trying to hit grand slams and do anything crazy. We just are trying to be conservative enough that we're not at heavy risk, but we're still trying to mitigate the risk of inflation. And so now you can see that they're able to generate slightly more than what they're spending. And when you have that, it gives us a little bit more breathing room because normally early in retirement, we're all spending a little bit more. We're traveling, we're getting houses, we're buying different vehicles, we're doing a lot of different things. And you can see that just that extra seven ended up helping them a little bit. And then you can see that some of the goals that they had, we ended up spending a little bit more. So at 67, they had in their plan to purchase a new vehicle. And you can see that took us from 900 to 879. But we're able to build that cushion for such an event. And then you're able to see, well, then we kind of get back on track. We start spending a little bit less later in retirement. That's very common. And then we have a choice. We can go back to the cash. Now we can go back to 65% cash. We weathered a lot of the joys and excitement of retirement. And then now we're at a part where we're just kind of like hanging out, we're doing our own thing, and it's a very chill environment. So if you're relaxing a little bit, then you can spend a little bit less, and then you can dial it back on the investments if you would like, or you can maintain it. I'll show you what the investment is. Like it wasn't anything crazy. We actually were still very, very conservative. We're only 35% in the market, and then we were 65% out of the market. But it was better than having all the money basically cash and cash equivalents, right? That's what bonds are. And so we're able to just make the smallest tweaks for them or increase the returns by about 2.5%. And that's really all you need. You'll be very surprised that when you're in the margins, how much those small amounts over time end up benefiting us. And so there's a couple things that I did want to share with you about the risk of just leaving, right? Just kind of leaving the market. And it is something that happens all the time. So what I am showing you now is there's a handful of these charts all over the place, but this one is one of those on Visual Capitalist, and it's the idea of timing the market because that's kind of what everybody's talking about, right? I'm going to leave the market because of COVID. I'm going to come back in the market after COVID. I'm going to like jump out as the dip is happening, and then I'm going to jump back in right before the rise happens, right? Like that's the idea. But what we are generally will see, and I'm going to show it to you in a couple of ways, is twofold. One is most of the best gains in the market are really close to the worst times of the market. And you've seen that in 2025 more than any other time, where during the first quarter, we lost $6 trillion because of all the tariff talks and all that other stuff. But then the second quarter, you saw we had gained that plus some. I think we had gained 8 trillion. So if you left in the first quarter when we lost the 6 trillion, you would have missed the growth immediately in the next month, right? I think the tariff announcement day was like April 1st, and I think May was probably the best month of the year. And so if you left in April, by the time you would have jumped back in, you probably would have missed a lot of the growth. And so these charts all kind of tell the same story. Is the idea that if you leave the money over a 20-year span, if you leave the money, $10,000, you would have had $65,000 from your investment. If you just missed the best 10 days, or we're talking about 20 years now, right? So I can't do the math, but 365 days a year, they times it by 10 years, I guess that's 3,000. So I guess we'll do the math. And 20 years would make that like 7,200 days. And if you just missed the best 10 days, it would have cost you significantly. It would cost you more than half of your return. The best 20 days and the best 30 is just the best month. That over a 20-year span, if you missed the best month, you basically broke even. You put in $10,000 and you would have 11,000. If you count inflation, that means that we lost because we haven't kept up with inflation, because the 3% of inflation would mean that we would need $20,000 just to maintain the same lifestyle. And so these charts basically show us the idea that if we leave the market during the best times, that you will see that, or during the worst times, that if we miss the best market rebound, which generally, like I said, happens right around the time of the loss, that we are going to be missing a lot of the gain. And so here's what you see down here. It says, when were the 10 best days in the market? And you can sort of see that they're right around the market dropping, right? So that was the Great Recession. You can see that right after COVID. You remember when everything started kind of closing down around March. And then we can see March again, right? So around COVID. And then you can see that as we were going through the Great Recession, all the 2008s and 2009s, and then you can see again, you have COVID in 2020. And so you can see what we're basically saying. Now, I have one more chart to show you about the risk of just timing the market. This is actually one of my favorite ones because it's obviously it's super colorful and there's a lot going on. So I always just like looking at this. But the idea that we're basically showing with this chart is you can see the annual return of like large caps, right? So companies generally over $10 billion in value, that it's about 14%. You can see that the best year was 32%. The worst year lost 18%. We will call that the range without being too technical. All we're saying is if you have an average return of 14%, the time that you have the 18% loss, it is more likely that you're going to have the growth because it is an average of 14%, right? So if you have the idea of flipping a coin, and generally speaking, we say it's going to be heads half the time, tails half the time, if you flip enough times. But if you have 20 tails in a row, then it's more likely that your next flip will be heads than it would have been that it would be tails, just because of the number of times. And so a lot of the time, because people are greedy, like that's one of those Warren Buffett sayings that I think everybody talks about. He's like, I'm cautious when the people are greedy, and I'm greedy when the people are cautious. He's basically talking about this type of a range, that when people are greedy, when it's a 32% return, everyone is buying that new hot thing. But the way that the range would work, since the average is 14%, it's much more likely that that next year that particular return is going to be much lower, because otherwise the range wouldn't be the average wouldn't be 14%, right? The average would be 20%, or it'd be 30%, because if we keep getting 30%, that will be the average. So it means that when you start seeing the highs, when the average person starts getting greedy, that technically means you should be expecting the lows, because that's what the range is. So that's what Warren Buffett is talking about. He's always quoted, but I don't feel like a lot of people generally have explained it to you, but that's the idea. The idea is if I see that the average return is 9.4%, and then 41% is the best and 25% loss is the worst, then Warren Buffett is going to be greedy during the times when other people are fearful. But so if it is losing 13%, it's more, or losing 25%, it's more likely that growth is in the near future than less likely. Now, of course, you have to go through the idea of choosing the stocks and the values of that particular company where we actually believe it's a good company, right? You can't just, everything doesn't go up. Some companies file for bankruptcy and go away, right? That's basically what I'm saying. And so you can sort of see, depending on the different assets, you can see how they kind of bounce around on their returns. That if I have a great year, that it's going to be for a time, and then the time kind of comes and goes. That you can see that it's a range where it's going to be high and it's going to be low. And that's all we're really saying, is that the return varies. That if you were sitting in the early 2000s, you're like, oh, real estate is crushing it. It has been winning for 5 of the past 6 years. And then you jump into real estate, and then you can see that it's been down here at the bottom. It has been underperforming lately, right? Year to date, it's actually one of the worst years for REITs this year, right? It's under 2%, not even keeping up with inflation. That's all we're really saying, is that if you're out there trying to time the market, it becomes a very difficult proposition. It becomes a difficult decision that for someone to make, that it's better to have a long-term approach, allowing the growth and things to happen. So for this, and we'll go back to the plan. What did I do with the plan? So I want to find the, all right, there it is. And so we'll go back to the plan. So for this particular one, let me zoom back. So the changes that we ended up making, as far as, right, they're already retired, so the investments had stopped. Their living expenses were $5,500. That's what they were currently at. And then they had paid off the house and different things like that. So it wasn't as much of a concern on that one. For them, we just adjusted their investments from like basically cash to just conservative. We're just going to make sure that we have an allocation that works for us, that's still relatively safe, but at least gives us just a small amount of cushion where we're maintaining the ability to afford our lifestyle. And then we were able to make those adjustments so that now that they're able to allow their Social Security to increase some, so they wait till their full retirement age for Social Security. That gave them the ability, that cushion that you saw with the numbers, to where they could take their foot off the gas, right? If they were someone that's like, I would like to be a little bit more heavily in cash, by the time we get to 67, by the time we pay for that car, by the time we're done with the trips, we can go back to a little bit more of even more of a preservation. We're already wearing conservative, but we can go even more preservation. Now, because of the fact they were retired and where the money was at and how they were spending, we actually did not do Roth conversions for this particular strategy. For them, the change that we made was how we withdrew the money out. So normally what happens is people will do pro rata. You just take an equal amount out of all your accounts, so you don't really worry about it. But for them, we're able to have it where the money is taken out from the taxable accounts first. So we have capital gains. So that's a lower tax rate. Then we do the tax deferred accounts, because they had a decent amount that was inside of that. They didn't have as much in the taxable account. Get rid of the taxable first. That's basically the first year. And then we're going to solely spend from the pre-tax account. So their 401k. By spending solely from the 401k, we weren't concerned about the RMDs that tend to happen a little bit later in retirement, because we were already funding the entire retirement from that account. So when RMDs happen, we have no concerns. We're already spending more than that, and we've already been spending the account down. And so there was really no reason to do a Roth conversion. So then as a result, we allowed their tax-free account to continue growing. By the time they spent down all the money in the taxable account, which was like $40,000, then we spent maybe it was 125. I think it might be 125. Then we spent all the money down in the 401k, which then was, I think, like $600,000. And then naturally it has the returns each year. Then all we have is tax-free money in retirement. So we did not have to do any of those Roth conversions. It was actually a very simple approach, because of the fact they retired and where the money was at and the way it was allocated, that we didn't have to get all fancy in the numbers. And so by doing that, by just changing the withdrawal strategy, we were able to give them $165,000 more in tax-adjusted ending assets. They paid $10,000 less in taxes, and they're able to have $90,000 less of withdrawals from their tax deferred accounts just by changing the order that we took the money out of. And so when you put those pieces together, just slightly changing the investment allocation, you see how impactful that ends up being, where we slightly change the investment allocation, we wait till the full retirement age, and then we just change the withdrawal strategy. We're able to go from a 0% to an 83% probability of success. We went from losing $20,000 every single year in our retirement accounts to having an extra 7,000 left over in our retirement accounts, to where we were able to have the extra money to then purchase the vehicles and do all the other adjustments that you would need. Now, for the last part, where the question is, all right, well, Dre, if I did that, right, if I took all my money out in COVID, how would I go about bringing the money back in? And normally the concern that most people have is, I know that the market adjusts, but what if when I make my purchase, it's actually at a down value? Right. So the way you would think of it is, let's say you have like investment A, investment B, we'll say investment C, and investment D. And to make the math easy, we'll say that we have like $1 million sitting on the side, right? Just to make the math easy for me. The idea that you would do is twofold. One is you would just say, I'm going to do my asset allocation and I'm going to buy it all on day one. So I'll put $500,000 in each of these, and then we'll basically see what happens. If that ends up being a low day for the market, then I'm going to generate a higher return. That there is no doubt that just buying it all on day one, giving your money the chance to grow and adjust with the market, that will give you a chance to make a higher return. The reality, though, is because we don't know what's going to happen, it's normally a better idea when you're going back into the market, no matter what the amount is, to actually do what's called, oh my gosh, what is it? What did I forgot it? I forgot what it's called. Anyways, I'll describe it, and then what it's called will come back to me before we're done. But the idea is, instead of me putting in all 1 million on day one, I will put in $100,000 each month over 10 months. And so what will happen is, sometimes the market is going to be up, sometimes the market is going to be down. Sometimes I'm purchasing it at a discount, sometimes I'm purchasing it, it's a little bit more expensive, but you'll have an average return that is going to protect you from the risk of making, the wrong choice. On this one, think of it almost like roulette. I'm going to go ahead, I'm just going to put it all on black and put it all on red, and we'll see what happens. On this one, if you do 100,000 each month, some months is going to be better than others, but at least you're allowing your money to grow and you don't have to worry about sequence of returns. And so the way that you would end up doing it, so 100,000 each month, you basically purchase 25K of each asset every month, no matter what, until the amount is gone. You're not going to make the emotional choice of looking and being like, is it doing well? Is it not doing well? Choose the asset allocation, make that decision, and then you will go ahead and do the allocations on that frequency. And the main reason that we do that is our concern with sequence of returns. So all sequence of returns is a very fancy way of simply saying that what happens if I lose the money at the beginning of retirement versus if I lose the money at the later in retirement, right? That's all it is. And so I'll share a quick chart with you that will show you what that will look like. And so let me see. Actually, it may be better to zoom it in. Yeah, we'll do it this way. Perfect. So when you're looking at this, you can see basically what we're saying is the investor A and investor B, they actually have the same returns, they're just flipped. So you can see that we had a 9% gain the first year and we end with a 5% loss. And you can see that the green investor had a 5% loss and ends with a 9% gain. So they actually have the opposite returns, but the same returns, right? 9, 11, 18, 9, 11, 18. Ends with a 15% loss, 6% loss, 5% loss, begins with a 15% loss, 6% loss, 5% loss. If you lose in the beginning, it starts to lower how much money you have in the account. And then when you start getting the returns, it's on a smaller amount of money. Right? So if you get a 10% return on $100,000, that's $10,000. But if you get a 10% return on $1,000, that's $100. And so you can see where it's relative to what the amount is in the account. If you get the returns early, your account grows and then you start having the losses, you're fine. If you get the losses first, when the account grows, it doesn't have the extra amount to save you. So you can see that Investor Blue has $106,000 in year 15, while Investor Green just has $36,000 in year 15. And remember, the only thing that changed was we had the losses in the beginning. That is why the idea of out taking my money and doing it on a regular basis, not doing it all at one time, but just allowing my money to slowly enter the market every single month, the exact same amount over a 10-month span, gives you the chance to make sure you don't have sequence of returns. That if for some reason that first month was an awful month, it's okay because you only put in 1/10 of your investments. And then you put in the next tenth the next month. And you technically can do that with any frequency. If you wanted to spread it out over 2 years, I mean, you could, and then you would just do whatever the math is. Whether that is like, I think it's maybe like $40,000 every single month you put in, you could if you wanted to. That's probably a little bit long. Normally, I wouldn't go longer than a year. So however, I want to allocate whatever amount is going to go in the market. I normally wouldn't make it take longer than a year because you already have spread out, you smoothed out the investment risk of sequence of returns. And so that's the way you would normally bring the money back into the account. All right, my scholars, that will be it for today. I'm always thankful for the time that we have together. If you are interested, I do have, and I will show it to you. You can go to happyretire.com. And if you go to happyretire.com, I do have a retirement roadmap that is available to you. It's absolutely free. And then you could just go from there. Let me see if I can get it to you to show it. So you go happyretire.com. And then you're able to sign up, and I will share with you our retirement roadmap, absolutely free. It has 10 different tools that can help you as far as preparing for retirement. And then you're able to just sign up and then go from there. It's absolutely free. And then you can use the tools as you would like. Until next time, I'm Dre Griggs with Obsidian Wisdom. Always thankful for the time that we have together. Until next time, stay safe and enjoy